Hey, what's going on, world? Ainsley D here with you. And in this video, I want to do a quick video because I started doing option trading, right? Trading on, the stock market using option trading. And it's been some ups and downs. And I just want to come on here and do this quick video and talk about some new things that I've learned and some mistakes that I made and wish wish I knew before I started basically option trading and losing some money. So one thing that mistake that I made was strategy doesn't match your outlook. So an important component with beginning of trading is the ability to develop an onlook of what to believe could happen. Two of the common starting point of developing outlook are using technical analysis and fundamental analysis, or a combination of both. So I had to start basically looking at the charts and understanding the charts before I end up jumping into a trade, because what I realized when I first doing option trading, I wasn't really paying attention to the technical analysis, because the technical analysis revolves around interpreting the market action, mainly volume and price on a chart, and looking for the different areas of support and resistance. So that's the key thing that I had to learn, was about support and resistance, and basically like the trends of what's going on, and identify the potential buy or sell opportunities, which you're going to do either buy or a call. Now, the second mistake I was choosing the wrong expiration date. Now, for me, what I was doing was, as with a lot of strategies, you try to follow different people and you try to like get in and try to get that fast money. Well, not even fast money, but you're trying to get that big win. So when I first started doing option trading, I had a good coach. Well, I still have a good coach, but I was jumping in trying to like put my feet into the water. And when I first started doing it, I was making good progress. I was doing some good trades and winning. But then I must have got too excited and I started doing over trading. And I wasn't realizing the exactly way of doing option trading the right way, like understanding the technical analysis. And another mistake I was doing was choosing the wrong expiration date. So after I had a couple wins, I started to keep going at it, like trying to do trades and stuff like that, but I was choosing the wrong expiration date. I was choosing shorter expiration date, which gives you it's less of a fee to buy the contracts. And I'm gonna go more into option trading and contracts later on in another video, but it gives you the less amount of buying the option. But when you choose a longer one, it costs more, but you have the ability to win even better on that one. So I was choosing the wrong expiration date. So as with strategies, you are faced with issues of having a multitude of different choices when deciding on the expiration date. So the good news is that developing an outlook that selecting the proper expiration generally falls into place. One way to help choose the best expiration for your outlook is having the simple checklist, like how long do I believe it would take the trade to play out? Is going to be a week or two? Do I want to hold the trade through an earning announcement, stock split, or other events like such a big news going on, such as earning? And also, is there adequate liquidity to support my trade? Is there enough money on my trade to support the trade at the time? Now, another mistake that I found myself with doing, I say mistake 3, was choosing the wrong position size. I was starting to choose the wrong position size, So most position size and error stems from two common positions: fear or greed, right? And I'm getting some of this information because some of the things that I've been through, in addition to some of this information is coming from Fidelity, from doing some research. So if you're greedy when making the decision, you could end up trading a position size that is too large for your account size. This may occur when a trade goes against the outlook and when you're stuck with crippling losses. So you just see it start dwindling, and you're not even setting a stop loss. On the other hand, you could be like some traders who trade smaller. Trading a small size is fine. I'm more like a small trader, but you may miss out on potential earning. And that's the thing about doing small trades, is you miss out on potential earnings. Like, oh, I should have held on to the trade longer, or I should have bought more contracts. But it's all a learning process. And once you start to learn once you learn the basics and start developing your own strategies, then it can pay out more. So a risk percentage of your account value could be 1%, 2%, 3%, etc. Use a consistent dollar amount that you don't want to lose, like $100 a week or $100 a day, how much you want to lose, and that's what stop your trading. Ultimately, when deciding on a size, you should also be comfortable with the amount of capital you will lose if you trade. And that's one mistake I made. I think I got like probably too greedy trying to get that win. So I would let some of my trades basically take a loss thinking that it will come back. Ideally, the trade size should be large enough to be meaningful to the account, but small enough so that you don't lose sleep at night. So you hear that? Large enough to do some trades, but when you're doing some trades and your losses, don't make your losses big, make them small. Mistake number 4 is ignoring the volatility of the market. Implied volatility is a measure of what the market expects volatility to be in the future or a given security. It is important to recognize if implied volatility is relatively high or low because it helps determine the price of the option premium. So it depends on how the volatility, how much a contract will cost. And remember, a contract is 100 shares is one contract. Knowing if the premium is expensive or cheap is an important factor when deciding on what option strategies makes the most sense on the outlook. So sometimes you could see a trade be a certain price, and based on the volatility, you can get that trade at a lower price. So you can probably put in your bid at a different price. So I'm gonna get into some more information on that later on down and do another video. So mistake number 5 is not using probability. Taking into account the probability for your strategy is an important factor when deciding to place a trade. Not only does it put into perspective what is statistically likely to happen, but it is essentially to understanding if your risk to reward makes sense. It is important to note that the probability has no direction bias. It is simply the statistics chance of bringing a price being at a particular level on the evaluation date, given the current factors. You can use different things like fidelity. They got a pro thing that you can use and things. Mistake number 6 is focusing on the expiration graph. So looking at the expiration, knowing that the expiration date is, and looking at your decay, if you're losing decay, because I wasn't paying attention. I'm gonna do a more detailed video of that, like your delta, your Greeks and all that. You have to watch the decay. So if you do a trade that's a short trade, that's within a couple of days, and like a swing, and not a swing trade, like a day trade, sometimes you can lose out on the volatility because you're gonna lose out when your Greeks be going down. And mistake number 7 is not having a trading plan. So you gotta have a trading plan. That's one thing I wasn't having a trading plan when I was getting to it. Another mistake would be not having a trading plan. So one of the first steps in avoiding common trading mistakes is to have a sound trading plan. A basic trading plan should consist of, but not limited to, how much you are willing to risk on the trade, per trade. Like me, I'm a small trader, so I try not to lose like about $50 to $100 a week on a trade. If I lose like $50 to $100 for the week, then I'm out. Then I try to like make about $400 to $500 a week by trading. Typically it end up being like $250 to $300, but can't complain, right? So how much are you willing to risk per trade? How will you find opportunities in the market to place? So basically me, I use basically the stocks that I'm into, like Tesla or SPY or SoFi and those ones like that, in order to get it. When will you enter the trade, and what is your exiting strategy? As mentioned before, fear and greed can lead to irrational decisions that could be that wouldn't normally make. Sometimes you find yourself FOMOing, and that was another big mistake I was making, was FOMOing into trades and not even like taking a step back. But I'm gonna get into some more details of how I'm able to develop my strategies over the past experience and being able to win a lot of my trades over the past few months. So I went from losing to back to winning. So it's a good feeling. So once again, it's Ainsley. Hope you got some value out of this. These were some ideas and mistakes to avoid. So 7 common option trading mistakes to avoid as a beginner option trader. All right. Talk to you later. Peace. Make sure you hit that like button, subscribe to the channel, and I'll talk to you later. All right. Peace out.